Good afternoon. Welcome to panel 3, where we're discussing health risks for work and finances. My name is Susan Wilschke. I'm with Social Security's Office of Research, Demonstration, and Employment Support. I'll be moderating this session. We will be hearing from 3 presenters today, Lauren Schmitz, Jeremy Burke, and Lauren Nicholas. So as a reminder, if you have any questions for the presenters, you can ask those at any time during the session using the Ask a Question button on the screen. So with that, let's get started. I'm going to start by kind of framing the discussion, and I will highlight some of the relevant findings from the panel. So these papers all look at how health risks can affect economic stability, both for working age individuals as well as for older adults. At younger ages, the risk is really about health affecting the ability to work, and that's tied to the likelihood of disability application. So we're really interested in this for a number of reasons. It's important to understand these trends. It can help us kind of see who's likely to apply and come on the rolls and better understand and predict the program growth. And it helps us to ensure that the program is both meeting the needs of and reflecting the current environment. And that includes the changing nature of work, both the types of jobs that are available and the demands of those jobs. I know that was mentioned early today as one of the priority areas, and it's something that we're really interested in, and we'll be hearing about that from one of our papers. At older ages, we're interested in helping people maintain financial security through their retirement years, and understanding what resources people have or what they need, and what those threats are to financial security and how those risks can change over time and how programs and strategies need to change. We're especially interested in understanding the needs of vulnerable populations, such as individuals with lower or diminished cognitive abilities, and thinking about really how programs and policies can best support people in different financial environments. So for SSA, we certainly have policies on representative payees that can help people who need assistance in managing their benefits, but it really goes far beyond that. So while these papers have different focuses, there are some threads that we see throughout them, talking about how we identify and mitigate risks, and also understanding trends that we're seeing and how those risks does change over time and how we can better address them. So I will briefly talk about each paper, and then I will sort of kind of wrap it up at the end. So next slide. Okay. So the first paper, Haradi and Schmitz, looks at whether occupations and occupational demands affect application for and receipt for DI benefits. They also look at genetic data to measure the genetic risk for several conditions. So they do find that when you look at the probability of DI application, social factors are actually more strongly associated with their DI applications than those demands of work. But conditional on application, those demands, the physical, mental, sensory demands are more important than the social factors. They also find that some of these genetic variables can influence application to DI as well as some of the outcomes. Next slide. Okay. So the next paper looks at the increasing complexity of financial products, primarily mortgage products, and examines whether this is driving an increase in debt among older individuals, and in particular, whether this is a problem for people with lower cognitive ability or people who are experiencing cognitive decline. And the concern is certainly that people might be pushed into products that they really don't understand and aren't equipped for. So the authors actually found that higher cognitive ability is associated with higher debt. It's not just housing debt, but that's certainly a part of it. They looked at financial literacy, and when you take that into account, that relationship between the debt burden and the cognitive ability kind of goes away. So you're seeing that people with higher financial literacy are taking on more debt in these kind of more complex environments. But even among those people with higher financial literacy, there's some evidence that they may be having difficulties managing their debts. And the next slide. Okay. And then the last paper looks at the financial risks of older individuals due to Alzheimer's disease and related dementias. Similar to the last paper, this addresses the concern that cognitive decline can make it hard for people to manage their personal finances. And they also look at whether certain financial behaviors may be early signs of Alzheimer's disease, other risk. And they did find that individuals who developed Alzheimer's disease were at a higher risk of missing payments up to 6 years before their diagnosis. And they're also more likely to have subprime credit scores prior to the diagnosis. So the paper that I read was looking at individual households, but I know that the authors are doing follow-up work on couples. I think Lauren's going to be talking more about that today. So I will wrap up talking a little bit about each paper. Last slide. So to start with the first paper, I think these are really interesting findings, and I can't help but think about some of the things that Ann Case was saying when we look at how the societal factors can make a difference in sort of the opportunity people have and how that influences their work. The paper also highlights, I think, the importance of early intervention, and it supports work that SSA has been doing in this area, looking at with other agencies, kind of looking at ways to identify and support people before they apply for disability benefits. When we talk about occupational demands, I can't pass up the chance to plug some of our work in our new occupational requirements survey. So I think it would be interesting to, when looking at the ONET data on some of these demands, we have our first wave of data available. It'd be kind of interesting to see how those requirements look with the ORS survey. Okay. Looking at Jeremy Burke's paper. So it's very interesting that their findings, don't support this notion that people with lower knowledge or understanding are being pushed into these financial products that they may not understand. And so in one sense, that seems positive. It still leaves this question of, increased debt and how that's changing over time. People may be borrowing more sort of as a tool that can help them get through challenging financial situations such as the financial crisis. But while that may be helpful in some ways, the authors kind of suggest that this group have less wealth and maybe perhaps less financial stability than earlier cohorts. So I think there's certainly more to look at there. And then looking at the last paper, again, this is a similar trend where they're looking at the role of cognitive functioning in managing personal finances. And also whether this is sort of this, this predictor of risk. Certainly, early diagnosis is very important, and especially when there seem to be early signs of decline that we can look at. So I think it does raise an interesting question about kind of how or if these financial changes can identify people at risk, and could health practitioners ask questions about finances, or is there a way to do that when you're assessing cognition? So as I mentioned, and if this was looking at single person households, I think it would be interesting to see what happens when you look at couples and whether the presence of a spouse is a mitigating factor when you're looking at these risks. So I will stop here. I really appreciated the opportunity to review these papers, and I look forward to hearing from our panelists. So I will now turn it over to Lauren Schmitz.
Thanks so much, Susan, for that great introduction. My name is Lauren Schmitz. I am currently an assistant professor at the La Follette School of Public Affairs at the University of Wisconsin-Madison. And this is joint work with Amel Haradi at Stanford University. We're grateful for funding from the RDRC, NBR, and also from the National Institute on Aging. Of course, our findings are solely ours and do not express the views or opinions of those agencies. So to kind of give you a little bit of context, we know evaluations of Social Security disability insurance, or SSDI applications, consider both health and vocational factors in their determination decisions. We also know from decades of occupational health research that jobs and health are related. Individuals in lower status jobs have worse health, and they tend to have faster declines in health at older ages. However, it's very difficult to disentangle these two factors. One possibility is that work environments themselves make people sicker, and that results in unequal DI claiming across occupations. But an alternative and non-mutually exclusive explanation is that life course factors independently cluster individuals in poorer health into lower status occupations. And so some of these life course factors could include childhood socioeconomic status, educational attainment, your health as a child, or even your underlying health or genetic propensity. Next slide. So we explore these hypotheses through 3 research questions. The first is, are differences in SSDI application, receipt, and denial a function of the occupational demands of applicants' employment histories? The second is, to what extent can these differences be explained by life course factors that affect occupational selection? And the third is, what is the role of underlying health in the relationship between occupation and SSDI? And here we're going to utilize genetic data to capture unobserved health propensity. Our DNA is endowed at the point of conception, and it's fixed across our life course. So our DNA is randomly assigned, conditional on our parents' genetics, and it never changes. So it's actually a good characteristic of an individual in that it allows us to look at the independent and interactive effects of underlying disease risk on DI outcomes, because it never does change. Next slide. So just to quickly summarize our findings, we find that social inequities that influence access to opportunity, including childhood SES, are more strongly associated with DI application than job demands. One exception here is a positive psychosocial work environment. So we find individuals who have greater control over how best to meet the demands of their jobs, that we find that this attribute is actually negatively associated with DI application. Next slide. And then we find that conditional on SSDI application, it's actually physical, mental, and sensory job demands that display stronger associations with SSDI approvals and denials than do structural or social factors. So these job demands play a stronger role in DI determinations, excuse me. And finally, we find that higher genetic risk for depression, cardiovascular disease, BMI, dementia, and rheumatoid arthritis are independently associated with DI application and approval. Next slide. We use rich data linked to the health and retirement study. So from the HRS core surveys, we pull information on demographics, education, childhood SES, and also employment history. And here we're looking at an individual's longest held occupation. So all the information you're going to see on these slides are based on an individual's longest held occupation. We then use SSDI records from linked Form 831 files to get all our data on SSDI outcomes. And then we independently link job demands from the Occupational Information Network to the HRS. If you're not familiar with the ONET, it's a large database of job characteristics that's produced by the BLS. And we use ONET to construct composite indicators that mirror the SSA medical vocational grid. So we look at physical demands, mental demands, sensory demands, environmental hazards. And then we also add a 5th dimension, which is the positive psychosocial work environment. So again, the degree of control and influence that an individual has, the amount of autonomy they have over their day-to-day workload. This is not part of the medical vocational grid, but we include it because of how strong these findings have, the psychosocial environment has been shown to be really highly related to workability and good health at older ages. So we include that in this research as well. And finally, we use an individual's genetic data, specifically polygenic scores that mirror frequent SSDI medical conditions. I don't have a lot of time to go over what a polygenic score is, but basically it's a weighted sum of a person's genetic risk for an outcome across all variants in the genome. So we basically create an aggregate summary of a person's disease risk for a particular disease. So each person has one number. It's a continuous variable. And so then it's very easy for us to include in our regression models. But it is based on whole genome information for each individual. Next slide. We use stepwise linear probability models to sequentially examine the relationship between DI outcomes and occupation, then job demands, then childhood SES and health. And then in separate models, we look at genetic propensity. The DI outcomes that we look at is whether or not an individual ever applied to DI, if they were approved if they applied, or if they were approved or denied for medical or work capacity reasons. We include the covariates that are listed there in all models. And then we do weight our estimates to account for complex survey design and respondents' consent to SSA administrative data linkage. Next slide. So this first slide is kind of our first results slide. So here you're seeing the estimated probability of SSDI application across occupations. Each bar represents coefficients from models that regress DI application on fixed effects for occupation. And the omitted category here is professional. So on the x-axis here, we have the different occupational categories. And on the y-axis, we have the estimated probability of DI application. The darkest bar here is our baseline model, and then the bars get progressively lighter as we add more coefficients, more variables to the regression model. So what you can see from just the baseline model is that there is a really strong occupational gradient in DI application. Workers in blue collar and service jobs are way more likely to apply for DI than workers in white collar occupations. But what we find here is that when we add job demands to the model, it doesn't do a whole lot to explain more of the gradient. So actually what we find is that education, childhood SES, and childhood health explain more of the occupational gradient in DI than job demands themselves. Next slide. So here we focus on results from the full model after all stepwise inclusions, but for all the outcomes that we look at. But here we're just going to zoom in on job demands. So I'm not showing you the results for all the other coefficients, but just zooming in on the effect of job demands on these different outcomes that we look at. And what you see is that there's a stronger relationship between DI approvals and job demands. So we don't find a whole lot of evidence that job demands influence application to SSDI, the one exception again being the psychosocial work environment, but rather we find that it comes into play more for approvals. So whether or not an individual is approved for medical reasons versus work capacity reasons. So in that column outlined in the green box, the outcome is equal to 1 if an individual is approved for medical reasons, and it's equal to 0 if they were approved for work capacity reasons. So we can see that the medical vocational grid here is doing its job in the sense that these job demands come into play more either in step 3 or step 5 of the DI determination process once you are at SSDI's door, so to speak. Next slide. And finally, we wanted to understand the role of genetic risk on the probability of application of SSDI and the degree to which underlying genetic risk interacts with job demands on your longest held job throughout an individual's life course. So here, every column represents a different polygenic score that we used in the model. We looked at each one at a time. And the outcome that we're looking at here across all models is application to DI. So what you can see here is that polygenic scores are associated with application to DI. So for example, a 1 standard deviation increase in genetic risk for depressive symptoms is associated with a 1% increase in the probability of application to SSDI. You do also see here a strong role of the psychosocial work environment, but we don't find that polygenic scores or kind of underlying genetic risk is really exacerbated by job demands. So we don't see any sort of interactive results here on this slide. Next slide. Next slide. So just to wrap up, we do find that there's a strong occupational gradient in SSDI application. We find that more of the gradient is explained by early life course factors like childhood SES and education than by job demands. And so what we think this signals for policy is that policies that mitigate social inequality earlier in the life course may reduce SSDI applications down the line. Second, we find that conditional on SSDI application, there is evidence of a match between job demands related to individuals' occupation and the determination process. So this signals that workplace interventions that improve job demands or allow for job transitions even within the organization may allow workers to remain employed. And finally, we find that underlying genetic propensity is independently related to SSDI application. And what this signals is that health and workplace interventions at early signs of health declines could attenuate SSDI caseloads. We want to stress that these genetic propensities are not necessarily prescriptive. So just because you have high underlying genetic risk for a certain trait or outcome does not necessarily mean you will have that disease in your lifetime. But what we're finding in this case is that those polygenic scores are highly associated with DI. So something is going on. And in this case, earlier interventions may be really beneficial. So thank you for your attention. And now we'll hear from Jeremy Burke.
Great, thanks Lauren, and thanks to the organizers for including this talk on the agenda. And this is a joint work with my colleagues Marco and Ari, which are investigating the relationship between cognitive ability, aging, and debt accumulation. Next slide, please. So as this audience is well aware, there's a large literature looking at older adults' savings accumulations and behavior, but comparatively less work looking at older adults' debt burdens and debt behaviors. And recent evidence suggests that this is actually a quite important area of inquiry, as recent cohorts of older adults are carrying significantly larger debt burdens than their predecessors, and this may leave them at higher risk of bad results due to financial shocks. So there's been some work looking at potential drivers for larger debt burdens in the population at large, looking at factors like looser underwriting standards and increased use of risk-based pricing. But there's been relatively little research looking at drivers behind older adults' debt burdens specifically. And one potential factor that may be particularly important for older adults is that over the past couple of decades, we've seen a large increase in financial product complexity. Next slide, please. So here is a chart we borrowed from Amraman et al., which documents the large increase in mortgage complexity in the mid-2000s. So prior to the early 2000s, the mortgage market was dominated by fixed-rate mortgages with a few arms thrown in. But then in the middle of the 2000s, there was an explosion of complex mortgages featuring either no amortization or negative amortization. And about 2005 and 2006, these accounted for about 30% of all mortgages originated in those years. And related research has found that other financial products have also increased considerably in complexity over this same time horizon, including investments targeted to households and other debt instruments. Next slide, please. So older adults maybe have particular difficulty navigating these increasingly complicated financial environments, as Agrawal et al. Suggests that financial sophistication peaks in midlife and then declines thereafter. And we may expect these difficulties to be particularly acute for those with the lowest levels of cognitive ability. And broadly, as Susan mentioned, there's been concern that with the increase in financial complexity, there may be widespread mis-selling of these newly complicated financial instruments to individuals with lower cognitive ability, such that they're being pushed into debt instruments they don't understand, and this may lead them to becoming highly indebted. Next slide, please. So that's what we're going to investigate in this paper. In particular, we're going to look at how cognitive ability is related to debt accumulation among older adults, and particularly whether this relationship or pattern has changed over time with the increase in financial product complexity. So to do so, we're going to use data from HRS and create 3 age groups. Our pre-retirement age group is going to be 56 to 61. Our retirement age group is 62 to 67. And our post-retirement age group, 68 to 73. And each of these age groups is going to be observed at 3 points in time, 1998, 2006, and 2014. So within each age group, we have a group that has been relatively unexposed to the increase in financial product complexity, a group that's been exposed but observed pre-crisis, and a group that's been exposed and observed after the financial crisis. Next slide, please. So like previous research, we find that there's been substantial increases in older adults' debt burdens over time. But we extend this and show that this extends even to older age groups than the previous considered. And actually there, it's actually really pretty quite stark. So this chart is showing average debt burdens at each time period for each age group. And you can see in the green bar for our older age group, 68 to 73, in 1998, average debt burdens and total debt is about $20,000. And this jumps to about $45,000 in 2014. And the percentages in the middle of each bar show the fraction of each age group that held this type of debt during that time period. So about 37% of households in our oldest age group held debt in 1998, and this jumps to 54% in 2014. Next slide, please. So as you might expect, much of this is driven by increased mortgage debt, and it follows a very similar pattern as the previous slide. Next slide, please. But that does not tell the entire story. In fact, we also see increases in debt across the portfolio. Perhaps most concerningly, we see increases in other debt, which includes unsecured debt like credit cards and medical debt, particularly at the older age groups. So between 1998 and 2014, both the fraction of older adults holding this debt and average debt levels increased about 80%. Next slide, please. So we are interested in digging a bit deeper and seeing what role cognitive ability might have in explaining some of these increases in debt over time. So cognitive ability, as measured in the HRS, is on a 27-point scale that measures working and episodic memory, which we use in our analysis. So this table is showing how cognitive ability is related to debt burdens across our age groups over our window of analysis. You'll see that we find a positive association, namely that individuals with higher cognitive ability are holding higher debt burdens. Okay, so the way to read this table is that for 1 unit increase in our cognitive ability index, in column 1 is associated with about a $1,500 increase in total debt on average. Next slide, please. We're not just interested in this raw association. What we're particularly interested in is how this association may have changed over time with the increase in financial product complexity. And we do find that the relationship has changed over time, namely that older adults with higher cognitive ability appear to be the ones taking on more debt in these more complicated financial environments. So in column 1, relative to their counterparts in 1998, a 1 unit index in cognitive ability, a 1 unit increase in the cognitive ability index is associated with $1,800 more debt in 2014 relative to 1998. Okay, so this is broadly inconsistent with the story that Susan outlaid at the beginning of the session, where financial intermediaries are pushing unsophisticated households into increasingly complicated financial instruments and leading them to be highly indebted. Rather, we see that debt burdens are disproportionately increasing among individuals with higher cognitive ability. Next slide, please. So that may be somewhat reassuring that the debt burdens don't seem to be disproportionately increasing among individuals with less financial sophistication, but we do find evidence that even these higher cognitive ability individuals appear to be struggling with these higher debt burdens. So here, this chart looks at the relationship between cognitive ability and total wealth levels, and we find this has also changed over time, particularly post-crisis. Individuals with higher cognitive ability are holding less wealth than they did in 1998. So 1 unit increase in our cognitive ability index is associated with $5,400 less wealth in 2014 relative to 1998. Next slide, please. Now, perhaps more concerningly, much of this relative reduction in total wealth is coming through liquid wealth, okay, particularly at the oldest age groups. So in post-crisis in 2014, 1 unit increase in cognitive ability is associated with $6,000 less total wealth for a 68-73 age group than in 1998. Next slide, please. So we find in our analysis that cognitive ability is, in fact, an important predictor of debt burdens in older age. And importantly, this relationship has changed over time with the increase in financial product complexity. Particularly, individuals with higher cognitive ability appear to be the ones taking on more debt in more complex environments. So this is broadly inconsistent with a story where there's widespread mis-selling of financial instruments to predominantly lower cognitive ability or lower sophisticated households, which is leading them to be disproportionately indebted. Rather, our evidence is consistent with recent research looking at individual securities and finding that proxies of financial sophistication are associated with opening more complicated financial products. We have a complementary analysis in the US where we introduce financial literacy, as Susan mentioned, which I don't have time to walk through here, but it is suggestive that cognitive ability in the HRS data is likely proxying for financial sophistication. Next slide, please. So all told, we find that older adults with higher cognitive ability are disproportionately taking on larger debt burdens in more complicated financial environments, and this has left them less financially secure than previous cohorts. Namely, they hold less wealth, less liquid wealth, and have higher debt to asset ratios than previous cohorts. So an important caveat to all this, of course, is that a lot of things are changing over this time period. So we can't attribute it all to increasing financial complexity, but I think our story is intuitive and fits with related research and really underscores the fact that financial fragility has increased among older adults. And this is true across the financial sophistication distribution and not confined solely to individuals of lower cognitive ability. So with that, I'll say thanks.
Great. Thank you, Lauren, and thank all the presenters for excellent presentations. I do have some questions from the audience. So the first one is a question for Jeremy from Anna Rappaport. The question is, do you think that the fallout of the financial crisis, 2008, and the big increases in housing values in some areas are relevant contributors to the increase in debt among older persons? And then the other part is, why do you see debt among retirees as a major problem?
Can you repeat the second part of the question, Susan?
Why do you see the debt among retirees as a major problem?
Yes. So I'll take the first question first. And first, hey, Anna, it's nice to hear from you. So yes, we do some additional work looking at regional variation and changes in house prices, which I didn't have time to show in the paper here. And we do find similar that is definitely a factor leading to increased debt burdens, and disproportionately among higher cognitive ability of individuals. People with higher cognitive ability seem to respond more to changes in house prices and take on more debt in response to changing market conditions. Second, I think it's concerning in the sense that the higher debt burdens a couple things. One, if they're older adults are then more susceptible to interest rate changes, and this may lead to, particularly if their debt is not fixed rate debt over time, it can lead them to more financial vulnerability to shocks in the future. And the higher their debt burdens, if they're on fixed incomes, the more of their fixed income is going to go towards servicing that debt, leaving less for other areas. And so increase in debt, all else equal, is going to lead to increased financial fragility on average across the population, which is our concern. But we're going to do some additional research looking at correlations with things like financial well-being and other subjective factors to get at this in more detail.
Okay, thank you. The next question is for Lauren Schmitz. This is from Dennis Heafy. So while presented in a positive light, does this sort of genetic information have the potential for abuse on the part of employers? Is it a red flag for the collection of this sort of data? You need to take yourself off mute.
Sorry about that. That's a great question. So currently there are laws in place. For example, GINA, the Genetic Non-Disclosure Information Act, that do prohibit the use of genetic data by employers to discriminate against their employees. So there are current laws in place to protect employees along these lines. So I'm not worried about it, employers using it against their employees or anything like that. I do think it's important to kind of use these variables or to look at these variables, because we do know that, genetic data are becoming more and more ubiquitous. It's really only a matter of time before most of the population is genotyped, and we are going to have to figure out, what do we do with this information? And as far as, my research and what I've seen, you can see that the genetic risk itself is actually a pretty small contributor. It's really a lot more about the social environment and in particular disadvantages in the social environment that really still contribute, to health inequity. So our genes are always working through the environment. So I see it as another risk factor that's important to look at to understand what the role of social policy is in reducing health inequities in the population, and in this case, DI determinations.
Okay, thanks. And then we also have a question for Laura Nicholas. What are some changes that one can look for in one's own financial behavior or a loved one that may indicate cognitive decline?
In our work so far, we've seen the missed payment to be one of the major predictors that are important. As we mentioned very briefly, it seems like different variables become more important at different ages, although we're still fairly early in that work. So for example, at age 70 and 75, things like numbers of new accounts, it's usually pretty rare to be needing a new credit card or a new type of loan at this age. at age 70, inquiries into your credit but not delinquencies become important. So I think we're still understanding some of the specific financial pathways. And the other thing that's important to note is that our data only allow us to include various forms of borrowing and loans and repayment, including credit cards. So there's a lot of anecdotal evidence to suggest that if we were also able to look at bank account data, we might see sort of changes in spending patterns that are also indicative of this behavior. So I think in general, it's sort of looking for these uncharacteristic changes. If you've always been very good at paying bills and suddenly things are getting missed, for example, that's going to be something to worry about. Although what's hard is that it can be challenging to notice for yourself if you're already starting to experience these cognitive changes.
And I'll ask a kind of a follow-up question on that. And are you aware of any, there's obviously a lot of tools and things that are out there for assessing cognitive ability and decline. Do they try to capture these things? Are they built into those things? And I guess, again, it'd be kind of hard as a self-assessment thing, but is there a way of measuring that you're aware of?
So most of the standardized instruments do not sort of jump into your finances per se, but there have been several studies sort of trying to find good ways of identifying just a few screener questions that can help doctors determine who might benefit from a more robust cognitive screening. And one of the questions that is consistently predictive is just a general, are you having new troubles managing money? One of our clinical collaborators talks about having patients bring in a checkbook, and you can look at whether you're not making the same number of payments you would in the usual month, or not adding things up correctly anymore. I think fewer and fewer people actually use checkbooks, and so electronic banking is going to make this research design more challenging going forward. And I think there have been some private market products coming on board that you give them all your information and they'll try to monitor for some of these things too. So certainly an area with a lot of opportunity.
Great, thank you. Well, I think we are at time. I want to again thank all of our presenters for very interesting session. I think we're going to take a short break now, and the next session will begin at 1:50. Thank you.